Namaste to all. I welcome you to yet another uh, panel discussion through a webinar mode by the Accounting Standard Boards of ICI. Today, what we are discussing is basically the effects of foreign exchange currencies, the fluctuation thereon. For that, we have two eminent panelists. One, the senior amongst us, CA Parveen Kumarji. He is the head of assurance and senior partner of ASA, and having more than 31 years of experience in the assurance field. His knowledge and expertise in Ind AS is well known. He has been a faculty for the Ind AS certificate course of ICI. He has been on the various boards of the ICI, ASB, AASB, and others. And his knowledge in the Ind AS and the accounting standard is so immense that whenever there are certain issues which are required, he is always there to contribute to the institute. He has written a few books. I welcome you, Parveen Kumarji, to share your knowledge on this subject today. Another panelist which we have today is CA Achal Jainji. Again, a regular contributor to our profession, has got more than 15 years of experience and been in part of various of the bigger entities, Big Four and Big Five and Six. His expertise into Ind AS, IFRS, US GAAP, Indian GAAP is again par excellence and has been a regular contributor to the ICI training programs on the Ind AS and auditing standards. He has been also the technical reviewer with the FRRB of ICI. To moderate these two, I would say, huge knowledge-based persons, we have got another knowledge-based person who is none other than CA Rajesh Kumar Jain. Though we say that he is from a smaller town than Metro, he is from Ludhiana basically. But if you see, and I have met him so many times and I've interacted so many times, his knowledge and the gripping of the subject on the accounting standards and income tax both is par excellence. He has been a rank holder both in CA Intermediate, CA Final, and he has been the chairperson of the Ludhiana branch also. He has contributed to the institute on various boards, and we are really fortunate to have such a person to moderate the two Star Worlds panelists. So I am very sure this session today is going to be a great session with the right moderator and great panelists. So having a good interaction amongst all us. So I welcome all of you three, and I request Rajesh Jainji to take it forward, the discussion on this very, very important subject.
Thank you, Pramodji. Good afternoon, Praveenji and Achal Jainji. I know they are the best in this line of accounting standards, and this subject is very close to my heart, this foreign currency transactions and its conversion. So we'll go one by one. We'll take the questions one by one, and already the specific question has been assigned to Parveenji or Achalji, as may be, and I think both of you are aware of it, which of the question has been assigned to Parveen Kumarji and C. Achal Jainji. So let me start with the first question, effects of changes in foreign exchange. What are the various standards available which gives us guidance on foreign currency transactions and its presentation or recognition in the financial statements? I think this question is to be answered by Parveen Kumarji.
प्रवीण जी अनम्यूट कीजिएगा, you're not audible.
So thank you so much, Pramod ji, thank you for giving us this opportunity to interact and share thoughts on this very important topic. So those people who are dealing with audits and those people in corporate who are into accounting field and dealing in foreign exchange related transactions, this is one area where we face a lot of challenges. And I think, Rajesh ji, thank you so much for putting up these questions. Some of the questions are very highly technical, and we had to do research, and some research we will carry on, because some questions relate to the intersection between the income tax, the ICDS, and the Ind AS and the accounting standards. So very technical kind of questions you have put up. So I think before we start answering those questions, or before we having the discussion, I think if Pramodji permits me, we must put a disclaimer that whatever we will be sharing, at least I can share from myself, that I'll be sharing my own personal views. This program is getting recorded and it will be there on the Institute website. From all perspective, the thoughts which we are, or maybe Achalji or Rajeshji or myself, we will be sharing, they should not be considered as the views of the Accounting Standard Board. So these are very personal views. Maybe the Institute may have a different view which might come up in the future. But as of now, what I have done or what we have done is compiled some response which are based on the literature which we could find and we could understand it. It is not, what we are sharing will not be treated as the view of the Accounting Standard Board or the Institute or the Council. That is number one. Second disclaimer, which is very critical, is that please do not take your final decision based on these discussions. When you are facing a professional assignment or a challenge, I think you should specifically look into the transaction and go for consultation, external consultation or internal consultation or a legal opinion. These thoughts which we are sharing are of very generic in nature. There may be specific situations which might demand further looking into other literature or other documents. So these are the two things which I thought I will share it before the beginning. So Pramodji, is it okay, or is it fine, sir?
No, perfectly fine, sir. Perfectly fine.
So now coming to your question, the question seems very simple. That which are the standards which deal with the these kind of transactions. So maybe Ind AS 21 and AS 11 is the answer which comes into mind as a flash. But when you look into deep, you will be dealing with the derivatives also. You will be hitting Ind AS 109 also. And in case of consolidation, you will be hitting Ind AS 110, 111, 112. Those kind of standards will also come into play when you go deeper into the transactions. But primarily these two in accounting standards, AS 11 and Ind AS, AS 21. So these are the two main standards which are dealing with it. But depending on the nature of transactions, so if you are dealing with PP, property, plant and equipment, and there's some long-term monetary, non-monetary kind of assets, so you will be hitting other standards as well, looking into that type of transaction. But primarily these two. But and Ind AS 109, of course, will hit you when you are dealing with the derivatives or financial.
Thank you, sir. We might not be covering any other standard like 109 or 110, 111, but that are definitely being affected on account of foreign exchange transaction. Then we'll look into these two accounting standards, Ind AS 21 and AS 11. So Achalji, I would like you to explain that what are the transactions which are not covered by these two standards.
Just
And
before
what are the
answering-
significant? Well, I'll take to the questions.
Sure.
What are the items or transactions not covered by these two accounting standards? And what are the significant differences between Ind AS 21 and AS 11?
Sure. Before answering this, I would again like to thank Sri Pramod ji and Rajesh ji, and definitely this opportunity for having this discussion with everyone. And I'll now move on to the question number first, which you specified as to which all transactions have not been covered by this standard. And I would say when we talk about Ind AS, when we talk about Ind AS and when we compare this Ind AS 21 with AS 11, one of the significant differences that we find is the coverage of forward contracts, or to a certain extent, we can say derivatives by AS 11, which is not there in case of Ind AS 21, because Ind AS 109 is dealing with that part. And that is where we can say that because there are certain derivatives, derivative transactions, derivative balances, which are covered by Ind AS 109. That's why those have been excluded from the scope of Ind AS 21. But when it comes to AS 11, of course, AS 11 gives the guidance on forward exchange contracts in terms of its accounting. Another part is about the foreign currency items when it comes to their hedge accounting. Now, hedge accounting is again one guidance which is captured by Ind AS 109. And that's why this guidance, because it's covered by Ind AS 109, that's why even though we are talking about foreign currency items, it's not covered within the scope of Ind AS 21, it's covered within the scope of Ind AS 109. Another important aspect is about cash flow statement. So when it comes to the cash flow statement, we may be dealing with certain differences or we can say the cash flow differences which may arise on account of the forex transactions which are there in place. Now, in respect of presentation of cash flow statement in respect of these type of transactions or these type of differences, again, the guidance is provided by a separate Ind AS, and that's why this has not been covered by Ind AS 21. Now I'll just move on to the differences between these two, because I think this will more or less clarify as to what all types of transactions are covered, not covered. I would say the most significant difference between these two standards, Indian GAAP and Ind AS, happens to be the functional currency. Now, this is one concept which did not exist under Indian GAAP, and this was introduced by Ind AS. And this is the striking difference, and I would say this is one of the most important difference, because this can really change the shape of the financial statements in case functional currency happens to be different from the currency which was used for reporting purposes, say under Indian GAAP. And we are going to talk in more detail about this functional currency. So that's why I'm not discussing too much around the functional currency, but this concept of functional currency doesn't exist under Indian GAAP. Secondly, we talked about forward exchange contracts, which are covered by AS 11. So AS 11 provides guidance on this in terms of their accounting, but this has not been covered by Ind AS 21. Third and other important difference, I would say, is in respect of certain long-term foreign currency monetary items, in respect of which some specific guidance has been put in AS 11, which is very commonly referred to as para 46 or 46A guidance. I think very popularly people know this guidance by the para reference instead of the nomenclature that we have been using. But when it comes to Ind AS, now Ind AS, I would say, in a certain manner has also captured this guidance in the form of an option of accounting, but that is available under Ind AS 101, and that too if the entity opts to do that accounting. Otherwise, when it comes to Ind AS 21, Ind AS 21 doesn't provide any sort of kind of exemption wherein this forex impact goes to doesn't go to P&L the way it's covered under 46 and 46A under AS 11. So again, this happens to be one of the differences between these two standards. Other difference, I would say, to a certain extent, we can talk about integral or non-integral foreign operations. Now, when it comes to AS 11 specifically uses these two terms, integral, non-integral, and this is very, very commonly known by all, because this also has an impact on accounting. Now, when it comes to Ind AS 21, even though it doesn't use these two terms, but still the concept, the underlying principles which it uses are very much in line with these two principles which are available under AS 11, but still the terminologies you will not find. So I would say these are some of the significant differences between these two standards.
Thank you, Achal. Praveen, I would like you to explain what are the significant differences between Ind AS 21 and IFRS 21, because India has adopted some part of IFRS 21 and which suits its economy and which suits its organization to present their own statements.
So basically, there's also a difference of presentation currency. So I will talk about difference between IFRS and Indian accounting standards. So in IFRS, IAS 21 deals with this situation, right? So one is that transitional provisions. So in IAS, the transitional provisions have not been given. So Ind AS 21, we have seen a lot of detailing which has been given, and also Ind AS 101 for the first time adopters. There's a lot of guidance which is available in Ind AS 101. So this is the first one. That detailed guidance is there. So second one is the scoping out, like Achalji shared that there was clause 46, 46A, kind of situation which was there in India before the Ind AS came. But in IFRS environment, that kind of guidance was not there. So there was, special paragraph, which is 7AA was inserted, which was basically to scope out the long-term foreign currency, these items, monetary items, for which the entity has already opted for that exemption. So, which is given in paragraph D13AA of Appendix D to Ind AS 101. So basically, that is the second difference. The third one is when we will talk about functional currency and we will talk about presentation currency. But in case there is a change in the functional currency, there are some reporting requirements, some disclosure requirements which have been explained in IAS 21, which talks about that not only you will give detailing, but will also give reason thereof. Whereas in Indian standards, Ind AS 21, that requires also there's a need of mentioning the date from where this functional currency has undergone a change. So there are those kind of differences are there, and also the functional currency detailing has been little more detailed here as compared to IFRS environment. So those are the main changes which I can think of.
Thank you, sir. Now it will go forward and look how these accounting standards affect the presentation and recognition of foreign exchange transactions. Achalji, as we know that 109, Ind AS 109 deal with more of the derivatives. But under Ind AS 11, what is the treatment of forward exchange contracts? Because that standard detailed forward exchange contract in a separate chapter.
Yes. So AS 11, when it comes to the derivatives, it talks about forward exchange contracts, and that too again can be segregated into two parts. One which are intended for trading or speculation purposes, and the one which is not intended for trading or speculation purposes. So let's talk about the one which is not intended for trading or speculation purposes. Therein, the guidance as per AS 11 requires, first of all, premium or discount to be computed in respect of those contracts. And that premium or discount, in case it is spreading over 2 financial years, it is required to be amortized over the life of the contract. Because if it is getting settled within the same financial year, there is not going to be any impact, because at the time of settlement, the entire impact will go to the P&L, and there's no amortization as such which is required. But in case this settlement of the forward contract moves on to the next financial year, then we need to amortize it. Amortize means, let's suppose we have 6 months period and the premium comes out to say X amount. So X amount proportionate to the current financial year will be recorded in the P&L of the first financial year, and the remaining amount which could not get recorded in the first financial year will then get recorded in the second financial year. And of course, at the time of settlement, this entire impact will get settled, and this will also eventually flow to P&L. So all in all, the impact is going to P&L. The only thing is it may get spread to 2 financial years, and generally it will be 2 financial years considering the nature of the forward contract, which is around this period only. Talking about the other one, wherein the intention is for trading or speculation purposes, therein the guidance is relatively simpler, I would say, because it simply requires MTM to be computed in respect of that contract. MTM, you can say, is the mark to market value. I think this is now very easily known in the context of Ind AS. This is very commonly done by the entities. And whenever we compute this MTN, so whether it is about gain or loss, this is then required to be taken to P&L. But let's suppose if we have got any contract which is outstanding as at the year end, there again, as at the year end, this MTM is required to be computed. And the impact or in all cases is going to P&L only. So that's the treatment as around all of these forward exchange contracts under AS 11.
Thank you, sir. Praveen sir, we are talking about functional currency, presentation currency. What is the major differences between the functional currency and the presentation currency? And since all transaction in other than currency than functional currency are foreign currency transactions, what are the factors which may be considered for determining an appropriate functional currency?
Okay, I think if we understand this particular aspect, I think 60% of the standard is understood.
Yes, that definitely.
So that is the main crux of this standard. And let me put it in very, very simple words. The presentation currency is currency in which you present your financial statements. So if you're writing your financial statements and you're putting in brackets on top, amount is in Indian rupees, that means you're presenting your financial statements in Indian rupees. So that Indian rupee becomes your presentation currency. In case you have written on the top that amount is written in US dollars, so that means you are presenting your financial statements in US dollars. So that currency, which is the part of your financial statement in which you are presenting your numbers, that is presentation currency. Now let us understand what is functional currency. So this is the currency which is called the primary which plays in the primary economic environment. So there are various transactions. I will try to use the simple language instead of using the standards language. So let us say you purchase your material and you pay in dollars. You make sale and collect money in dollars. You raise your invoices in dollars. Your capital is has come in dollars. Your borrowings are in dollars. So primary, you're dealing with dollars. So that means the dollars USD becomes your functional currency. The functional currency is the currency of primary economic environment in which the entity operates. What environment the company is operating in. So that functional currency, you have to record your accounting transactions. Any currency other than this currency will be treated as a foreign currency. And on that, you will evaluate what is the exchange rate now, what is the exchange rate on the closing date, how much is the difference, how to deal with that kind of difference. If you are trying to get into a contract with a banker or somebody to hedge your risk, how that accounting has to be done, what was the impact. So all those transactions which are other than functional currency will be treated as foreign currency transactions. So the primary economic environment will normally be the one in which which it primarily generates the revenue or spend money, spends the cash. It is normally the currency of country in which the company is operating, normally. But as I had mentioned that even if it is a subsidiary of a US company working in India, the capital has been infused, in dollars. It has got converted into Indian rupees and come here. Then the borrowing is in dollars. The export is happening, that invoicing is happening in dollars. Purchase is primarily import, which is happening in. So you have to do evaluation, which is the primary economic activity, which currency is the company is dealing with. That currency becomes the functional currency, and you need to write your books of accounts. You need to record your transaction on that currency itself. So the same standard, it's the same standard defines presentation currency as the currency. So there are three currencies which I have spoken about. The functional currency, the primary economic environment in which the company is operating. Presentation currency, the currency in which you are writing your accounts, and the foreign currency. Any currency in which the company is dealing with, but that currency is not the functional currency. So you are dealing with the foreign currency. So now, how do we identify what is my foreign currency? And what are the factors which can be considered for determining an appropriate functional currency? That is something which has been a matter of debate across the globe. When IFRS were written, or when even Ind AS we were preparing those standards, there were a lot of discussion and debate happened around this concept, how to identify. And then a lot of these guidances have come from US GAAP as well. So there can be various factors, which can be considered while identifying what is your functional currency. So one is the currency that mainly influence your sale price, revenue. That is the first one. Revenue can be sale of goods or sale of service also. Then, so this is the first factor. That revenue is primarily, which currency you're dealing with, how you're raising invoices in which currency. So from India, you can raise invoice in dollars, you can raise invoice in yen, you can raise invoice in Indian rupees. So what is your main currency in which you are recognized, your revenue is getting affected? Second is the currency of the country whose competitive forces and regulations mainly determine the sale price of goods and service. So there are various regulations which are dominating your company's activities. Currency that mainly influence the labor, in which currency you are paying to your labor, to your employees, your material, your expenses, other cost of providing goods or service. These are also important factors. And then there are, how are you keeping your funds in your bank account? Are you keeping the money in terms of Indian rupees, in terms of US dollars, in terms of yen? How you are keeping your money in the bank account? So that is also one factor which cannot be ignored. And then the other factor is how you're retaining your receipt from operating activities. So primarily the factors can be sale, can be capital, can be your borrowing, can be your cash in bank. So those are the factors which are taken into account, and then you decide what is your functional currency. So the currency which dominates the most, all these factors, your labor, your cost, your expenses, your income, your cash and bank balances. So that currency, which is the maximum, the dominant one, will be treated as your functional currency. As you can understand, it's not very, very simple thing which we are talking about here. It's very complex, and especially for the companies which operate in international environment. So they have to be very carefully choosing and identifying what is their functional currency. And the companies which are working in ERP environment. So this question becomes very, very relevant because ERP environment will pick up the numbers as that functional currency, and other than this will be treated as a foreign currency. So when your books are written, presentation can be done in any currency. You need to just translate. So, but very critical is to have an understanding of this concept of functional currency. So when Ind AS was coming to India, there was a lot of debate, a lot of questions, a lot of answers, a lot of discussion and happened around this concept of functional currency. But I think I tried to simplify and explain it to you in very, very simple terms. That country which is the currency which is the most dominating one will be treated as the functional currency, and that will be the base for accounting.
Thank you, Praveen sir, explaining this very complicated issue in a very elaborate manner, because this is the basis on the which we are all this standard is based upon. Actually, now, since Praveen ji has already explained what is functional currency, I would like you to explain, can functional currency be voluntarily changed? And in what circumstances the entity may be required to change in its functional currency? And when it changes its functional currency, what are the procedures for translation if it changes its functional currency?
Yeah, so just moving further from where Praveen ji has just left, see, when it comes to the functional currency assessment or determination, basically we are looking at the underlying transactions, or in very simple terms, we can say we are looking at the business model of the entity. Now, business model of the entity is driven by its transactions, whether those are domestic transactions or international transactions, whether we are talking about sales, purchases, costs around it, funding, or the cash flows. So one has to understand that it's not a matter of choice when it comes to determination of functional currency. So if an entity which, let's suppose, has a functional currency on the basis of various underlying factors which have just been discussed, gets to have USD as its functional currency, cannot choose INR just because it wants to keep INR as its functional currency. So it's not a matter of choice. Yeah. So we can say that functional currency will always be determined based on the underlying factors or the underlying transactions. It's not a poly choice available to the entity. Secondly, now with the context of this discussion, we can say that whenever this business model of the entity will change, the underlying transactions will change. Say, for example, the earlier model never included sales outside India, and that's why all the transactions were domestic and all the transactions were in Indian currency. But now the entity has changed its business model significantly, and most of its transactions are, let's suppose, with US, and wherein the transactions are impacted by the US economy rather than Indian economy. So that's where the business model has changed, and that is where the entity will have to now reassess whether it will continue to have INR as its functional currency or it needs to change it. So that's why, again, the functional currency will have to be reassessed, and this is what standard also requires functional currency to be reassessed at every reporting year. But practically, we don't see this functional currency to be changing year on year, because you'll not see an entity changing its business model significantly year on year. Yeah, but whenever the underlying transactions will change, definitely functional currency will have to be reassessed, and it may bring in a change in functional currency. Now, whenever the functional currency will change, this change has to be prospective. It cannot be retrospective. So we'll not go back to the previous periods and will not restate each and everything which has taken place in the past on the basis of the previous functional currency which was in place. It has to be prospective. So that's why the day when the functional currency is changed, yeah, so that cutoff has to be determined, and that is the day when all the translation rules will have to be applied on the basis of this new functional currency as compared to the old functional currency. And as regards all of these translation principles, we are going to again have a detailed discussion as we move further.
Thank you, sir, for explaining this functional currency, that it is not choice available with the entity. It is to be predetermined before
Yes.
it records this, start its recording its transaction. It is to be predetermined that what is the functional currency of the entity. Now, as regards presentation, can the entity present its financial statements in currency of its choice? Since functional currency, it cannot be given by choice. It has to be determined primarily before recording the transactions. But for presentation purposes, can the entity select its currency by choice?
Yes. So again, just continuing with the discussion which Praveen ji has done. So functional currency and presentation currency are two different concepts. So functional currency for any entity as a whole will always be one. It cannot be multiple. But when it comes to presentation currency, now presentation currency is not necessarily required to be same as functional currency. And this is again something which an entity can choose. So an entity can choose presentation currency to be any currency other than the functional currency. So it's a kind of choice available, and there could be various factors around it. So let's say for example, an entity which is having say INR as its functional currency is required to give its financial statements for consolidation purposes to its parent company, and therein it is required to translate its financial statements into USD, and that is where the presentation currency will come into picture.
Thank you, sir. Thank you, Achal, sir. Now coming to the recording of transactions, since we have gone through what is functional currency and what is presentation currency, I request Praveen ji, please explain how are the foreign exchange items translated in the financial statements, and what is the source of exchange rate between the foreign currency and the presentation currency.
So I'll answer the second question first.
Okay.
Source. The first, this is the first source is the way you are making a payment or you are receiving the payment. That's the first source, the rate at which the transaction is happening. The second source can be, let's say, at the end of the reporting period when you're preparing your financial statement and you need to translate. Then there are various sources which are available. So you can look into the Reserve Bank of India or the State Bank of India closing rates. So those are the sources from where, the companies, the listed companies and other companies, they pick up the rates, which are closing rates of that particular area. Now, in order to record the transaction, I would divide it into three broad areas. One is the monetary items. So when you're recording, your transactions, so they are translated at the exchange rate. So monetary items are translated at the exchange rate on the reporting date. Non-monetary items which are measured at historical cost, so they are not translated. The non-monetary items measured at the fair value in foreign currency, they are translated at the exchange rate at the date of when the fair value was getting determined. So you can always divide your transactions, whether these are monetary items, whether these are non-monetary items which are kept at historical cost, and then the non-monetary items which are carried at fair value. So for each one, you will have, for the reporting period, you need to have, that exchange rate. And as I had mentioned, you can pick up the rates from various reliable sources.
So for this monetary and non-monetary items, we'll have separate discussion in the forthcoming questions. Till that time, it is more than sufficient. Hello.
Yes.
We'll have explain detailed discussion on this monetary, and I'll request you to throw light on these monetary and non-monetary items in the forthcoming question. Till then, it is perfectly fine. And I request Achal ji, please explain what is the procedure for translation when the presenting the financial statements in currency other than the functional currency.
Sure. I would say, I would say this is rather simple in terms of the translation and very commonly done. So whenever financial statements are to be picked up, we'll pick up all the assets and liabilities, and they are required to be translated at the closing rate. So when we talk about the closing rate, we are talking about the rate on the reporting date. That has to be 31st March. The other component is going to be the P&L, wherein the standard requires the rate of the date of transaction to be picked up. But practically that is not done considering the volume of the transactions of any entity. So therein the practically what we see is average rate is being used. And when it comes to the average for the year can be considered for the purposes of this translation. So this is how we translate both the components, whether it is about balance sheet as well as the P&L, and this is going to give us some difference. And this difference is what we call as FCTR, foreign currency translation reserve, and that is how this is required to be translated from the functional currency or into the presentation currency.
Thank you, sir. Praveen sir, how we have talked about standalone financial statement. How is the presentation currency determined for consolidated financial statements? Because sometimes entities, subsidiaries or associates, or they have owned their business spread across the world. So how is the presentation currency determined for consolidated financial statements?
So basically under Ind AS, please remember that the group functional currency concept is not there.
Yeah.
You have to remember that it is entity's functional currency, the main entity, that will be taken as the basic, the base for this translation. So basically, the parent entity's functional currency, that should be the main currency in which the reporting will be done. So the group functional currency concept is not there in Ind AS. So each entity in the group, they will prepare their financial statements in their own functional currency, each of those components, and will translate these financial statements as mentioned by Achalji into the reporting currency, and that will be that will come to the parent entity, and that is how the consolidation will happen.
Thank you, sir.
The component will prepare their financials according to their functional currency, and then they will be translated into the reporting currency of the parent entity, and the difference comes because of P&L item and balance sheet item or statement of affair items. So that will be treated according to the standards, and that is how the consolidated financial statements will be prepared.
Thank you. Because in this case, we don't have any group currency concept.
The concept named.
Praveen sir, then starting with, first of all, when there is any transaction in foreign currency, at which rate the transaction is initially recorded in the books of account? Whether it is, I'm not talking about monetary or non-monetary item. Whenever there is a transaction, first transaction is there, and how we record that transaction initially in the books of account.
So, Rajeshji, like the way I was explaining, the company's functional currency is the base. So, whichever transaction is happening in whichever currency, on the date of transaction, that exchange rate has to be applied, and recording has to be done according to the functional currency in the books of accounts of the entity where we are talking about, where we are recording the transaction. So basically the thumb rule is the functional currency. So if I'm dealing in I'm working for an Indian company, and my purchase is in Indian rupees, sale is in Indian rupees, my bank account balance is in Indian rupees, and my expenses are in Indian rupees, all those factors I will see. I have determined that, okay, my functional currency is Indian rupees. So whichever transaction has happened, if it is other than Indian rupees, on that date of transaction, whatever the exchange rate is, I will record that transaction in Indian rupees. So it's the date of transaction which primarily determines, the recording of transaction.
Thank you, sir. Actually, when we record a transaction in foreign currency, it may be settled within that accounting year, or it may not be settled. It may be settled in the coming accounting year, or in it could be spread over 2 to 3 accounting financial years. I would request you to explain how are the foreign exchange gains and losses recognized in a case transaction is settled within the same accounting period in which it has occurred, or it is not settled in the same accounting period, it is settled in the next accounting period or in subsequent to that accounting period.
Sure. So talking about the foreign exchange gain or loss which may arise in respect of an entity's transactions, and we are not really talking about the consolidation principles or the translation of any other entity's financial statements. First principle which we need to understand is that any foreign exchange gain or loss will always go to P&L. This is one. Now, if the transaction gets settled within the same financial year, so the impact will go to P&L, and there's not going to be any foreign currency balance, whether it is about asset or a liability. Okay. Now, this is first scenario. The other scenario is where the transaction is not settled. So when we say the transaction is not settled, that means we are going to have a foreign currency denominated asset or a liability. Now, therein, we need to understand whether that foreign currency asset or liability is monetary or non-monetary. In case that happens to be monetary, then it is required to be restated at the closing rate as at the year end, like Praveenji mentioned. And any change which arises due to this restatement will again go to P&L. Now, the third situation is wherein the transaction is not settled within the same year, and that's why we have some foreign currency asset or liability, and wherein this asset or liability is non-monetary in nature. Now, in case it's non-monetary in nature, so mostly this is not required to be restated as at the year end, as at the closing rate, except in a scenario wherein the asset was fair valued. Because in case the asset was fair valued, then we need to restate it on the day when the fair valuation was taken place. We can say when it was measured at fair value, and the difference between the rates when it was originally recorded as compared to the date when it was fair value, this difference will again go to the P&L. So that is how we need to capture all of these foreign exchange gains or losses. But all in all, these will go to P&L always.
Thank you, sir. Before we move on to the next question for Praveen sir, I would request both the finalists to answer these two questions which is in the chat box. First one is from Noji. Premium on forward contract will be distributed between two financial periods in the proportion of time of forward contract. Is it correct?
Actually, you would take this?
Yeah, sure. Yes. So this is correct. In case there is any premium or discount that is required to be picked up proportionately over the life of the contract. Yeah. So when we talk about the proportionate period, so we need to first of all pick up the life of the contract, and this life of the contract, whatever is the period, over that period it will be amortized. Now, in case this period is spread on 2 financial years, then one period, or you can say proportionate amount to first period, will fall into first financial year, and the balance amount will fall into the second financial year. So that is how it's required to be recorded. So I would say what you have asked for is correct.
Okay. The second question, Praveen sir, for you. Presentation currency. Regarding presentation currency, can the entity select presentation currency ignoring stipulations in local laws like Companies Act, FEM Act, or local authority like SEBI, RBI, or ROC?
So you cannot ignore the local regulations in case you want to get your assessment done, or if you are submitting it to SEBI, or if you are submitting it to income tax. You cannot say that I will put my balance sheets and P&L in US dollars and will submit there. However, so you're primarily, you will take care of the local regulations. You cannot ignore it. But the concept which we are trying to understand is that in case you are a subsidiary of a foreign company, like what example Achalji has also shared, is like if it is a US company and you are a subsidiary of US company, your parent company requires your financial statements in US dollars. So for the purpose of submitting to your parent company, you can translate your financial statements in US dollars. So you can always make US dollars as your presentation currency for that purpose. But primarily when you are working in whichever jurisdiction you are working or the company is working, you will need to make a presentation of your financial statements according to the requirement of that country. So that jurisdiction. So I think ignoring the law is not the right word. Basically, what we are dealing with is in case you need to present your financial statement in some other currency, what will be that called? That will be called presentation currency. And the difference is how you will deal with it. Like, Achalji has mentioned that you will translate it according to the rates for statement of affairs, the date, the rates on the date of reporting, and for P&L, the transaction rates. So, and then you will deal with the differences according to what guidance has been given in the standard. And you will make a financial statement in that particular currency that will be called presentation currency, which you can choose. I mean, if you have an office in Europe also, you want to make another financial statement presenting your numbers in euros or in pounds or in yen, whichever country currency you want to present your financial statements, you can do that. However, please remember that jurisdictions will require you to, like for India, you will need to require your to present your financial statements in Indian rupees, and it's very logical also.
Yeah, definitely. That means you can have, you can present your financial statements in more than one currency. That if you are in a Indian entrepreneur or Indian circumstances, you are doing your business for SEBI, for ROC, for the company, that you have to prepare your financial statement in INR, and for your overseas controlling authority, you can present your currency in that USD or Euro or whatever it may be.
Absolutely, absolutely.
And sir, there is one question which keeps on doing like this, that which bank's exchange rate is to be taken, whether your company's on bank rate or always the SBI rate is to be taken, because there is a lot of difference. Sometimes the exchange difference, if we take SBI rate or we take any HDFC bank or ICICI bank rate, there is a huge difference between these two banks' rate, and the spread in between the purchase rate and the sale rate.
So when you look at the framework of accounting standards in India, that very specifically give you some characteristics of your financial statement. One of the main characteristics, is consistency. That's one of the basic characteristics of your financial statement, basic need. So generally, generally speaking, when I talk about the practical side of it, the companies will pick up, let's say they decide as a policy that they will pick up SBI rates, and maximum companies, they pick up SBI rates. So they need to maintain the consistency throughout. One fine day they say, no, we have HDFC rate is better and we want to take HDFC rate. They cannot. There has to be logic, and there has to be a consistency in following the policy. Now, if the company has picked up RBI rate as a policy of the company, then they will need to consistently do that. Whether HDFC rates are high or ICICI bank rates are high or low, it doesn't matter. So consistency has to be maintained. So what I see in practical life is many companies, they look at each other, what other people are doing. Oh, they are all doing SBI, I will also do SBI. So they'll pick up rate from there. So theoretically, you can ask the question, but practically speaking, the guidance primarily comes from the framework of the accounting standard, where you need to maintain the consistency. And generally, in the first instance, they will see here and there what other people are doing, they will do the same thing. And that is also, very prudent to use, the market practices, the general practices which are being used. So theoretically, your question is right. There may be a difference in the rates. But if your company is bold enough, if your company is decides to take a particular bank, then they will have to tomorrow answer the auditors. They have to answer the regulators why they have picked up this particular bank. There has to be some reasoning, and the board and the audit committee will have to answer those questions. So in case you are from auditing community, you can also, put up a question that why have you picked up this as a base, even if you are following it consistently. Can you please share with us what was the base why this decision was taken by your board? So then the whatever is practice is being followed in the market by the other companies. If that answer comes to you in writing, so then it is fine. I mean, this is perfect. So standards give you guidance on how to deal with these kind of situations, like for example depreciation rates, for example useful life. So these are when the companies are making the policy, they need to have some kind of reasoning and some kind of basis on which they are deciding that this is how they are planning to do. I hope that answers this interesting.
Income tax in few of the instances say you have to adopt SBI rate.
That's why I'm saying that, because there are various factors which are when a company is starting preparing financial statements, there are various factors, like for example income tax is one factor. Then there can be your competitors, or maybe the companies with which you deal in. There can be various situations. Yeah.
Thank you, sir. Praveen sir, one more. Then now coming back to our questions. What is the scope of Ind AS specifically with reference to foreign currency derivatives which are not covered under Ind AS 109? Because most of the transactions in currency derivatives are covered in derivative contracts are covered in Ind AS 109, but there are certain specific reference to foreign currency derivatives which are not covered by Ind AS 109.
So when I long back, when I started reading the standards, and then when I started looking into the presentations, and especially some very senior experts, they used to talk about derivatives. They used to talk about embedded derivatives. They used to talk about hedge, and it was very fascinating. I thought I'll learn how to understand these terminologies, which are hedge accounting and embedded derivative and other contracts. So it's very complex. Then I went to a seminar, and he was mentioning, a very senior professional was mentioning about the person who headed International Accounting Standard Board for many years. And he said that I was trying to understand IFRS 9 financial instruments. And he said that I've been there at that seat for last more than 20 years, but till date, I have not yet understood. So if somebody tells you that he understands financial instruments fully, I think he's telling a lie. So it's very difficult to understand completely, these transactions of derivative, embedded derivative. But coming to this question, primarily, some foreign currency derivatives that are embedded in other contracts.
Yeah.
That is something which Ind AS 109 does not deal with. So those items which are not dealt with in 109, they'll fall in Ind AS 21. That's a very simple and straight answer to that question.
Which of the derivative contracts are parked into some another contract?
Other contracts, yes. And it's very complex. I mean,
yeah.
If you are doing an audit, and if you are looking into foreign contracts, you need to really understand, apply mind that, okay, there is an embedded, so there's hidden, transaction which is going to have an impact. So there is a derivative there, which is embedded there. So that will be dealt with in this particular standard.
Thank you, sir. Achalji, now earlier we were talking about this monetary assets and non-monetary assets. Now we'll explain what are the monetary assets and what are non-monetary assets. Then Praveen sir will explain how these transactions are converted into foreign currency and how the gains and losses on monetary items and non-monetary items are dealt within the financial statements. So Achal sir, please, first of all, let us know what are the monetary assets and non-monetary assets as far as financial statements goes.
Okay, so I'll talk about monetary items as well as non-monetary items, and I think it's very important in the context of this standard because there are a couple of reasons. One, when it comes to monetary and non-monetary, I have seen in many cases that this is being overlooked now, and this is quite a few times ignored by many companies when it comes to the translation, or we can say recognition of forex gain or loss as at the year end. Secondly, even if we talk about monetary assets or monetary liabilities or monetary non-monetary assets, non-monetary liabilities, there's still a confusion as to what should become monetary and non-monetary. I would say we can just simply go by one principle wherein we need to just answer a question. Is there a right or an obligation to deliver fixed or determinable units of currencies? Now, if we say yes to it, then the asset or the liability will become monetary. Otherwise, it will become non-monetary. To give a few examples, let's talk about bank deposit. Let's talk about bank balance. Let's talk about cash. Let's talk about trade receivables. Okay, all of these are fixed. All of these are quite determinable. Now, if I have to compare this with inventory, for example, now, when it comes to inventory, though the value of inventory is fixed, there's no doubt. The management has assessed that. But still, when it comes to the right to receive against this, is that really fixed or determinable? The answer will be no. So that's why, even though we are calling debtors as monetary, we will not be calling inventory as monetary, and inventory therefore will become non-monetary. I also see a confusion as around advances, where when it comes to advances to vendors or advances which we receive from the customers, there's still a confusion around it, and I have seen practices being followed to treat it as monetary or non-monetary. So again, just to answer this particular part, and I think this to be important in the context of our discussion today. So that's why I picked up this example specifically. I have always considered this to be non-monetary because one, this is required to be settled as against the goods or services which are going to be delivered or rendered. So that's why I would say this is a more acceptable practice rather than treating it as monetary. So that is how I would say monetary and non-monetary is always required to be assessed. Rajesh ji, you are on mute, please. We missed you. You are on mute. You are muted.
Sorry, sir. Thank you, Achalji, for explaining the difference between the recognition of monetary items and non-monetary items. Now I'd request Praveen ji, please explain how is the carrying amount of a monetary item or the non-monetary item determined on a valuation date for a foreign currency transaction? And then what are the differences in the recognition of facts of changes in foreign exchange rates for monetary and non-monetary items?
So the first one is very, very simple. I think if you are dealing with, I'll give you an example to explain it. If you're dealing with property, plant and equipment related item, you need to deal with accounting standards which are dealing with PPE.
Yeah.
So you will need to have an answer, direct connection with the standard in which you are dealing with and the kind of transaction which you are entering into. And the second one, so there are again, first is initial recognition. Second is at the reporting date. And then the question comes about the exchange rate difference between, the rates. So initial recognition is recorded, in the functional currency I have explained very detailed. We had a discussion about how the functional currency is determined. So the moment your transaction happened, initial recognition is on the date of transaction. The exchange rate is taken on the exchange rate. And then at the reporting date, you have understood what is the difference between monetary and non-monetary. On the reporting date, if it is a monetary item, then you will be using the closing rate, right? Closing rate of the reporting date. And in case it is non-monetary item, then again it can fall into two categories. One is non-monetary items, which is kept at historical cost. And second is the non-monetary items which are carried at fair value.
Yeah.
If it is carried at the historical cost, then there is no requirement of exchange rate change because you are carrying it at the historical cost. But in case it is a fair value, then your date of when you are doing the fair valuation, that rate of that date to be taken. Now, when you're having these kind of translation, that exchange rate difference will come up. So exchange rate, the difference of in exchange, it arises on the settlement of monetary item or on the reporting, an enterprise monetary item at a rate different from those which are initially recorded. So reporting date and initially recorded date, there may be a difference. So they have to be recognized as a rule of thumb in P&L account, income and expenditure account. However, there are situations like we spoke about, the hedge instruments and where the hedge is effective, where the hedges might not be effective. So in those cases, where the exchange difference on monetary items, which are qualifying as a hedging instrument in a cash flow hedge, should be recognized initially, in the OCI. So that is something which you need to keep in mind, and that will also be to the extent of if the hedge is effective. So the gain or loss on non-monetary items, they are recognized to P&L. Basically, the rule of the thumb is P&L, other than where you have been given guidance by various standards and specifically related to hedge accounting, where the hedge is effective. To that extent, you will take it to OCI. Otherwise, it will go to P&L.
Thank you, sir. The same question which were earlier regarding which rate is to be taken, whether RBI rate or I would request both the panelists, because this is a practical difficulty for all the entities. It is a practical difficulty for the entity also. It is also a difficulty for the auditors also. Picking up a RBI rate clause unnecessarily foreign exchange gain loss, because even if sale is booked by RBI rate, payment will always come using the rate of conversion of the specified bank through which the documents have been lodged. Definitely, this causes unnecessarily foreign exchange gain and losses. If we pick up using the bank rate, then this loss or profit in the financial statements can be avoided. Is this the correct understanding? This has been asked by same person.
So I think if I speak very, very practically, then most of the companies, they pick up SBI rates. So there is no confusion. But theoretically speaking, what you are saying is right. If you pick up RBI rates and at the end of the day, you are making payment according to the rate of that particular bank, theoretically speaking, you can take up, that rate as a base. There is no guidance given in the standard that you have to pick up RBI rate or SBI rates. It's a company's decision. So if you want to pick up HDFC rate, most welcome. You can do that, but you have to, record your reasoning, and you have to put it in the minutes of the board, because tomorrow the regulators, the auditors, all the people, SEBI, they will be asking you a question. Why have you picked up HDFC rate when other people are picking up this particular rate? So when you talk about the standard talks about, standard doesn't give you any specific bank. So that's what the answer is from my side. Maybe Achal can add to this.
Achalji, please add something to it because it is a day-to-day problem.
Yeah, so I agree with you. It's a very, very common problem, and I'm surprised only one of the participants has raised this query. I was thinking as if everybody is going to put up this question, and this has come to me quite a few times. And on this point, I would say, what Praveenji has specified, consistency is extremely important. So this is particularly because of the fact that we can't follow this convenience accounting, or we can say the accounting which is supporting the numbers that we want to present in the financial statements. There's no point considering that logic while considering any of the sources. So let's say, for example, in the current year we have, or say in a particular quarter we have used SBI. Say in the next quarter HDFC suits us more, so that's why we are shifting to HDFC. Third quarter RBI suits us more, so that's why we are moving to RBI. Fourth quarter, there is again a very, very commonly used website, wanda.com, so that's being used. So this inconsistency is bringing in a lot of variations in terms of the financial reporting, which is incorrect. So if I was the auditor of that company, I would definitely want to question the management as to why they have been using this, because this is really having impact on the numbers which are moving into the financial statements. And if the management believes that in a particular quarter they want to follow any source, they should also have this policy to use that source consistently on a go-forward basis. Maybe in the past years they might have used some other source for some other reason, but now they believe this source is going to be more helpful to them. And I'm talking it only from the practicality point of view. There's nothing theoretically which has been specified, but consistency is very important. Otherwise it will become a convenience accounting, or I would say an accounting which is supporting their numbers, which is not acceptable.
There is no specific reference to any rate in the accounting standard, but since suppose we are booking our forward exchange transactions through a specific bank, that's HDFC bank, or we are dealing all our foreign exchange transaction through HDFC bank, that it will be more appropriate to take HDFC bank's rate, because that will be close to your transaction rate.
Yes, that's correct. I agree with you. But in such a scenario, when we are dealing heavily with HDFC, or we can say only with HDFC, it will be more appropriate not only to limit the usage of HDFC rates to the forward exchange contracts, but to any other transactions which are in foreign currency, which this company has been dealing with, because that will bring in the consistency in terms of usage of rates, whether it is about forward exchange contract or whether it is about any other foreign currency transaction which this entity has entered into during the year.
And frankly speaking, to top it up, tomorrow the company may decide to move to the other bank, Axis Bank.
Yes.
What will happen? What will you tell the regulator that we change the policy of changing from, because the bank has changed, we have also changed the rates, the basis for the rates. So that's why you have to see what is market practice, what is the practice being followed in the market. So if everybody is picking up a rate which is given by the State Bank of India, so better the company follow what other people are doing in the market. And very rightly Achal has put up that it should not be taken as a convenience that you want to support your numbers, and that's why in the beginning only I said that this particular standard is very, very critical, very important, because it is directly impacting your bottom line of your financial statements. Because in case, so I can share with you one example without naming the company or the context. So they had initially picked up clause 46A you had mentioned. So they had picked up a policy that we want to, take our exchange rate profit or loss to the P&L. And on that particular year, the exchange rate fluctuation was very high, and they were There was a significant amount of loss which they were planning to. So they come to me, they said that, no, we wanted to have a policy to capitalize this. So can we do it now? It's been 4 years. I said, you can't do it. In my opinion, you can't do that, because the option was given to you that whatever policy you pick up, you will not change it later on. So convenience should not be looked into. What is important is the consistency and what the standard is saying. So that is something which is critical. And these foreign currency transactions, they are very, very, so companies which are dealing in these transactions, their numbers get affected very significantly because of these exchange rate fluctuations.
Thank you, sir. Actually, now moving on to this foreign operations, which we refer into Ind AS 21. What are the circumstances in which a monetary item receivable from or payable to a foreign operation may form part of the net investment in that foreign operations? Generally, it is only the investment part, this equity holding or any other instrument. But sometimes there is a monetary item receivable or payable to a foreign operation which may form part of the net investment in foreign operation. What are those circumstances?
I would say there's just one circumstance wherein in respect of any long-term receivable, I'm just taking it as an example, wherein the settlement of that long-term receivable is neither planned and nor likely to take place in the foreseeable future. For example, let's suppose there are two companies. One company has given a loan to another company, and there's no time frame, there's no agreement, there's no repayment which has been going on as around this loan. Yeah, so this is something which becomes in the nature of, I would say, a kind of investment rather than calling it as a receivable. So that is where this principle comes into picture, and that is where this receivable or this long-term receivable gets into the shape of this net investment in a foreign operation. Yeah, so that is something which is required to be looked at. Now, as regards this foreseeable future, the terminology which we have used, this has not been specified. This is quite judgmental. But what I've seen as per the practices, 5 to 10 years is generally considered as the period for us to consider whether it is a long term or not. And secondly, there's always a history of repayments which is required to be looked at. And when we talk about the repayments, it's about the principal which has to be repaid. If the principal is not getting repaid at all, and the amount is lying with the company which has taken the loan for example, say last 5 years, 6 years, then this is nothing but a net investment in a foreign operation. So that is how it is required to be then treated as per Ind AS 21.
That means when there is a little movement or no movement at all in the trade receivable or the trade payable or the loans or advances, that amount can be considered as a part of investment in foreign operations.
I would say no movement instead of little movement, because when there's a little movement, at least we can demonstrate some intention is there to repay. Yeah, but when it is no movement and there's no agreement in place, there's no documentation in place through which this amount has to come back, because that was never, see, it's important to understand the intent of two parties over here. The intent of two parties in such a case is not to get the money back over a long period of time. And that's why they have not specified any time period. That is where you will not see any repayment happening.
So has it to be in a writing or black and white, or whatever be there, that the intention of the parties is to be seen, or the history of the transaction is to be seen?
Both are required to be looked at, and I think through the history we'll also be knowing the intention of both the parties, because if you talk to both the parties, they will not clarify as regards their intention. And secondly, documentation is generally found to be missing in these scenarios, and that's why they are keeping it in dark in terms of the time frame which is expected as around the repayment of this amount, or whether this amount has to come back at all or not. So that's why this history of repayment becomes important for us to look at, and that is where we can question the management as around their intention as to why this amount has not been moving over the period, which is quite significant now.
Thank you, sir. I have now your view on what is these kind of items which form part of net investment in the foreign operation. Praveen sir, can you explain how the differences of these kind of items which account for investment in foreign operation, which are how should these be treated in the financial statements?
So basically, when there is a exchange difference which is arising from a monetary item that form part of the reporting entity's net investment in foreign operation. So, for example, a subsidiary or an associate or a joint venture, it shall be recognized in P&L when you are making the separate financial statements for the reporting entity. Or in case you are making individual entities financial statements of that foreign operation, you will take it into P&L. So when you are making a financial statements which includes the foreign operations also, so for example, the consolidating financial statements you are making, where your foreign operation is a subsidiary company, then such exchange difference shall be recognized initially in OCI, and then will be reclassified from equity to P&L on disposal of the net investments. So you need to be really careful when you are dealing with foreign operations and when you are doing the consolidated financial statements. So when you are making a standalone, you need to take it into P&L. When you are making, so there may be a possibility that these transactions are between the parties also. So you need to also understand that concept of elimination, which is being, when you are making the consolidated financial statements, you need to eliminate the entries also. So you need to be really, really careful, and you need to go into details of what guidance has been given in the standard, and what guidance, where the standard is prohibiting you and where the standard is asking you to take it to the P&L. So as I had mentioned, the thumb rule is to take it to the P&L, but in case of certain situations, you will need to take it to OCI.
Thank you, sir. Thanks a lot. Achal now we have understood what kind of foreign operations are there. And now when we translate the foreign operations, what is the procedure for translation of foreign operations?
See, when it comes to the translation of foreign operation, I would just say it's similar to what we do in case of a translation of financial statement of, say, any other entity, something which we talked about. So all the assets and liabilities are required to be moved to the closing rate. So we translate them as at the closing rate. Then we pick up the P&L of the foreign operation, wherein again the standard requires us to use the actual rate of the date of transaction. Practically, we use the average rate, and once we do these two, there's going to be a difference, and this difference is called as this difference is then taken to equity routed through OCI, and this difference is commonly called as foreign currency translation reserve. So that's the principle which is required to follow.
For average rate, we have to take the monthly average or the annual average?
No, annual average will pick up, or I would say the average for the period. So in case the period is 9 months, 10 months of the foreign operation, so that's the average which we use. Because even if we pick the average for the month, then for every month the P&L will have to be picked up, and that will have to be translated for that particular month, and then eventually all of those months will have to be averaged out. So what I've seen, average for the period is picked up for the purposes of conversion of this period.
Thank you, sir. Praveen sir, there are, in all different countries, we have a different reporting dates. Then what is the treatment when there is a difference in reporting dates of foreign operations and that of Indian entity?
Yeah, this is something which we found a very, very practical situation there. So when you're preparing the consolidated financial statements, primarily the foreign reporting entity, they generally make additional financial statements on the date of reporting and send it for consolidation. However, when we look at IFRS environment and IFRS framework, and similar framework is being used in India for Ind AS, I believe that there are different reporting dates are also acceptable, provided the difference between these two are not more than 3 months. So basically, when you apply Ind AS 110 for doing the consolidation, so the different dates, they are permitted. So option one, the first priority is that the reporting entity, which is the foreign entity, should make a financial statement of the same date as when the consolidation is happening. So same date of reporting entity. But in case they have done another closing already and they are not in a position to do, then the difference between two reporting dates should not be more than 3 months, and effect of major items has to be taken into consideration. So that means you need to have a very careful understanding of the closing rate. Practically speaking, the instructions are given to foreign entities to prepare the financial statements as on the date of closing of the reporting entity. That is generally which is being done in the market. But standard allows that you can have a gap of maximum 90 days or 3 months to look into to do the consolidation also. But at the same time, the standard says that you are required to make adjustments for effects of any significant transactions which have taken place between those. So suppose the foreign entity has closed their financials on 31st January, and you are making a report on 31st of March. So whatever has happened between January and March, you need to consider, and in case there are significant items, you will need to make an adjustment. So that is something which is very critical, and Ind AS 110 allows you to have that kind of different dates.
That means for 2 months or 3 months or 1 month, whatever be the period, we need not account for all the transactions, or we need not to account for all the profit and losses.
So significant transactions, you need to make adjustment.
Okay. So in as regards consolidation, all the intragroup balances are eliminated on consolidation. How are the gains or losses on related foreign exchange transactions accounted for in consolidation?
So they are recognized in the rule of thumb P&L, unless it arises from a monetary item that forms part of reporting entity's net investment in foreign operation, in which case it is taken to OCI. Otherwise, the rule of thumb will play a role, and you will need to take it to P&L account.
All the exchange differences arising on consolidation, whatever will be the difference, that has to be taken into the profit and loss account.
And remember, there is a concept of elimination which is very, very critical out there.
Thank you, sir. Thank you, Praveen ji, sir. Achal ji, what as regards the foreign operations, in case there is a disposal of foreign operations, it may be total disposal or partial disposal of foreign operations. What is the treatment of exchange differences arising at the time of disposal of these foreign operations?
Just continuing from the translation principle, so whenever foreign operations are translated, so we get some FCTR. Yeah. Now, in case this foreign operation gets disposed of, now comes the time to move this FCTR to the P&L, because this FCTR moved from OCI, and from OCI it moved to equity, and it never really impacted the P&L. So now when this operation is getting disposed of, or I would say when the control is lost, that is the time when this FCTR will move from equity and then it will go to P&L. So this is going to be the treatment as around the impact as around this exchange difference at the time of disposal of the foreign operation.
So thank you, sir. Now we move on to the tax impact. Tax impact as per Income Tax Act on all these transactions, which we have already talked about, that the transaction has to be recorded into profit and loss, monetary item, non-monetary item, foreign operations. And then we come to the income tax part. And for this, Achalji, please explain what are the key differences between AS 11 and ICDS 6 when we read Section 43A and Section 43AA of the Income Tax Act.
So again, I would say it's very important in the context of the topic that we have been discussing, because eventually everybody wants to look at it everything from the taxation impact. Yeah, and that is where ICDS becomes important. But before touching upon the differences between ICDS and accounting standards, whether it is about AS or Ind AS, one has to understand that ICDS is again a kind of guidance which has been provided by income tax. But whenever there's this sort of collision, or whenever there's anything which is overriding between ICDS and the taxation rules or requirements of the act, therein it's been clarified that the act or the rules will prevail as against the ICDS. So that is one thing which we has to be looked at whenever we assess something from accounting side as well as from ICDS side. I'll just touch upon some of the key differences between these two, because I understand we are going to discuss all of those differences in more detail as we move further. One, when it comes to ICDS, so ICDS look at the foreign operation as only of overseas branch. So now, if I compare this to Accounting Standard 11, Accounting Standard 11 will cover subsidiary which is outside India. If we are talking about the Indian scenario, if we talk about joint venture which is outside India, if we talk about associate outside India, all of these will become the foreign operations. But when it comes to the ICDS will not consider all of these as the foreign operation. ICDS only talks about the overseas branch. So this is one. Secondly, like AS 11 has done, integral foreign operation and non-integral foreign operation. Now, this is one aspect which has been defined by AS 11, and we also discussed about Ind AS that this concept, this terminology is not there, but this concept is there under Ind AS. But this terminology or this concept doesn't exist under ICDS, which means that if there is going to be any impact which arises due to this change in accounting, which is because of this integral or non-integral, then this will not be considered by ICDS. ICDS will consider as if the foreign operation is part of the entity itself, or I should say as if that is integral always rather than non-integral. So something which is going to be a change in the form of accounting by considering that as a non-integral foreign operation will not be considered by ICDS, and that's why that will bring in the adjustment whenever we'll be preparing our computation of income tax. Another difference could be in the form of this accounting guidance which AS 11 provides, and which again comes from the requirements of this para 4646A, which is about long-term foreign currency monetary item, which is not considered by ICDS. Another requirement which is kind of difference between these two would be in the form of, I would say, the way non-monetary items are treated. Okay, now we have understood as to how non-monetary items are treated. Now how non-monetary items are treated under AS 11. So that is again different as compared to what ICDS requires. And next difference I would say is in the form of certain derivative contracts. Now, the way AS 11 requires, just to give you an example, AS 11 will treat some of the forward exchange contracts which are held with an intention for speculation purpose, trading purposes. Therein we compute the MTM. And this MTM is required to be computed at every reporting date. Now, this is not something which is considered by ICDS. ICDS will not take this MTM year on year, period on period. ICDS will only consider the impact of the settlement of the contract once this contract is settled. So that means every time we compute this impact of MTM and which we take to P&L will not be accepted by ICDS. So that will again bring in a bring in one adjustment when we do this computation of income tax as per ICDS. So I would say broadly these are some of the differences, but as we move forward, we are going to have more discussions around some of these differences.
ICDS does not talk about this integral or non-integral operations. For ICDS, all transactions converted for foreign operations are integral part.
Right.
So you have briefly touched about on derivative contracts as per ICDS. I would like you to explain in further effects of changes in foreign exchange rates. This ICDS 6 provides guidance on accounting for certain derivative contracts such as forward contracts and other similar contracts. Which of the derivative contracts are not in the scope of ICDS 6 and how these derivative contracts would affect the financial statements and the computation of total income of the entity?
Right. So I'll just specify, though I talked about this particular aspect as around the derivative contracts. Now, derivative contracts in the context of AS 11, as we have discussed, are basically the forward exchange contracts. And forward exchange contracts, once again, we can say are of two types. One which is held for speculation or for trading purposes. The other one which is not intended for trading or speculation purposes. And the accounting treatment of both these types is also different. Now, I'll talk about specifically as around those contracts which are intended for trading or speculation purposes. As we understand under AS 11, that these are required to be captured at MTM. So we'll not be considering any premium or discount in these type of contracts. We'll only be considering their MTM. That means we'll mark them to value. And this is something which is required to be done at every reporting year. Every reporting year will do this. Now, when we come to ICDS, ICDS doesn't accept this principle. Okay, yeah. ICDS doesn't talk about this principle. So ICDS says that once this contract will be settled, only then it will be accepted by ICDS. Okay, so therein, in a way, income tax is saying that I will not accept this gain or loss till the time this contract is settled. So let's understand the situation as to what is going to happen. So let's suppose in a particular financial year, in a particular financial period, management has booked a gain or loss. Now that will come as an adjustment when we compute the income tax. But in the next year, when this contract gets settled, any adjusting impact which is going to arise will go to the computation of income tax. Right? So this is something I would say which impacts the financial statements of an entity is a kind of difference also, and something which ICDS requires us to consider.
Means for all these kind of derivative contracts which are held for speculation purposes, we have to make adjustment in the financial statements. But right, for computation of income, we then have to readjust to make it compatible with the ICDS 6.
Correct. Because for accounting purposes, we'll have to go by the requirements of accounting standards. And then comes the computation of income. Now, computation of income has nothing to do with accounting standards, because therein will go by the Income Tax Act or the income tax rules or the circulars, notices, as well as ICDS. Yeah, so some of the things will align with what accounting requirements say, and some of the things will not align with what accounting requirements say, and that is where the adjustments will come in. And this happens to be one of the adjustments which is required to be captured because of ICDS.
Just to add, indirect impact will come through MAT route.
Yeah.
So that will take care of your book profit.
Right.
So that impact might be also be considered. Right. The moment we talk about MAT, Pramod ji will appear. A lot of discussions and a lot of indirect impact on the tax because of these accounting standards. The entries are coming and they are hitting P&L. So companies, a lot of companies, they check. They say that, okay, whether the guidance is there in ICDS, we take care of, the actual tax computation. But on the other side, on the back room, there's a calculation which is hitting on the MAT as well.
But for MAT,
the only thing is, the only thing is if the companies are into section 115 BAA or BAB, then there would be no MAT impact, because then MAT is not applicable to them.
Yeah. That's why I said that the expert appears the moment you talk.
Thank you, sir. Thank you, Pramodji, for rejoining. But
No, I was there, sir. I was listening to the whole conversation.
thank you, sir. Thank you, sir. So, as Praveen sir, as per subparagraph 3 of paragraph 8 of ICDS 6 regarding forward exchange contracts, firm commitment contract shall not include assets and liabilities existing at the end of the previous year. And what is the difference on this account between ICDS 6 and AS 11? In case of firm commitment, sometimes contract is made during the year when it is only a firm commitment. But at the end of the year, that firm commitment is converted into asset or liability. Suppose we enter into a forward exchange contract on 1st of January for export to be made in the month of February. At the date of getting into transaction, it is a forward exchange contract which is not intended for trade speculation purposes. But on the 31st day of March, when we prepare the financial statement, that forward exchange contract, underlying asset is being created against that forward exchange contract.
So
And what is
first of all, let us understand the term which we are using. Actually, each term which we are using will require a detailed understanding, but we are having a paucity of time. So I'll very briefly touch upon that firm commitment. What is firm commitment? Basically, it's a binding agreement for the exchange of specified quantity of resources at a specified price on a specified future date or dates. And a forecast transaction is an uncommitted but anticipated future transaction. So we need to understand that we are talking about firm commitment. Now, paragraph 3 of paragraph 8 of ICDS 6 regarding foreign exchange contracts, the firm commitment shall not include asset and liability existing at the end of previous year. So, on the other hand, AS 11 is not applicable to the exchange difference arising on forward exchange contracts entered into a hedge to hedge the foreign currency risk of the future transaction, in respect of which the firm commitments are made or which are highly probable, forecast. So we need to have a very clear understanding what accounting standard 11 is talking about and where AS 11 is not applicable. So this is something which I wanted to highlight, that we need to be more careful. Maybe Achal can add to this.
Achal sir?
Yes. So I don't have much to add to this, but in the context of firm commitment, I think we are just trying to highlight one point, that we are not talking about recognized assets and liabilities. So it's something which is limited to the signed agreement which is in place, and that is what is being discussed in the context of this guidance over.
Correct. Absolutely.
But sometimes contracts are entered into highly probable forecast transaction is entered into a forward contract. But by the end of the year, that underlying asset or liability is being created.
Yes, sorry. Yes, please go ahead.
If we have an export order, we book a forward exchange contract against that export order. Till that time, no underlying asset or liability has been created. This is only an order against highly probable forecast transaction, or what you call it, a firm commitment, because we have received a purchase order against that transaction. Till that date, this forward exchange contract is out of the purview of AS 11. But before the year end, that export gets accounted for, and the asset and liabilities being created. Asset in case of export, asset is created. But when the transaction was entered into, forward exchange contract was entered into, it was not, it was a firm commitment transaction or a highly probable forecast transaction, which is out of the purview of AS 11. But by the end of the year, that underlying asset is created against that forward contract. Then how to account for these under AS 11? And but because ICDS 6 says this firm commitment shall not include assets and liabilities existing at the end of the year.
See, when it comes to the accounting requirements, I would say we need to draw a line here. First of all, we need to understand as to when the firm commitment has got executed. Okay, the moment it gets executed, will have an asset or a liability in place. And again, the accounting requirements are very clear on these two aspects also, before the execution or after the execution. Yeah. So I would say the discussion that we are having over here is something which is limited to the time when the execution has not taken place. And that's why we are saying that the assets and liabilities have not got recognized and we are limited to the firm commitment. I would also specifically highlight this point particularly because of the fact that firm commitment is a terminology which is generally used or which comes into place wherein the recognized assets or liabilities are not there. For example, if we talk about forward exchange contract, if you go to a bank will always ask you to specify as to what is the underlying behind this. So is it a probable transaction which is going to happen, or is it a firm commitment, or is it around some of the debtors or the creditors which you have in place? Yeah, so in the context of that forward contract, we need to look at this accounting as well as this guidance which is available under ICDS. And that's how we need to segregate this into these three stages, I would say.
Thank you, sir. Thanks a lot. Actually, now ICDS 6 requires foreign exchange differences but pertaining to non-integral foreign operations. We have partly discussed it in brief. Pertaining to non-integral foreign operations to be recognized as income or expense on year-to-year basis, unlike AS 11, where they are accumulated in foreign currency translation reserve account and recognized in the profit and loss account only in the year of disposal of foreign operation. Please clarify how the same shall be applied for taxpayers having foreign branches.
I think it's been clarified in the question itself, but I would still elaborate on this a bit. Let's understand the accounting requirement once again. So accounting requirement says that in case there's a foreign operation, we need to check as to whether it will become integral or non-integral. In case it's an integral thing, then this will become part of the entity itself. So it's very much part of the entity wherein we'll do this accounting depending on whether the asset or liability is monetary or non-monetary. The second scenario is wherein we call the foreign operation as non-integral, wherein this relevance of monetary and non-monetary goes away, because we'll apply the principles of translation of non-integral foreign operation. Understood? And in the second scenario, FCTR will come into picture. FCTR is this foreign currency translation reserve. So this is how accounting is required to be done. Now, let's understand what is the requirement of ICDS. Now, ICDS is doing away with these two terms. But if it is doing away with these two terms, it means ICDS is electing one of these terms. And what is that term? Integral. So that means ICDS considers this accounting as if it is integral. So in case we have integral foreign operation, there's no difference between accounting as well as ICDS. Now, when does this difference come into picture? The moment we have non-integral foreign operation wherein FCTR has been recognized. Now, in such a scenario, ICDS will treat it as integral foreign operation and will require segregation of assets and liabilities into monetary and non-monetary and recognition of foreign exchange gain or loss, considering that as integral foreign operation. So that is one part where the change will arise and which will go to adjustment, which will go to this computation of income as adjustment. The second adjustment will be around this FCTR, which got generated in the books of accounts because of the accounting which we followed, and that again will become a kind of adjustment when it comes to the computation of income. So that is how it is required to be looked at, and that is how it will impact the financial statements, or we can say the computation of income of an entity.
Thank you, Achal, for explaining this in a very good manner, understandable manner.
Sure.
Praveen sir, there is one question regarding 43 of the Income Tax Act. The exchange difference relating to foreign exchange liability or borrowing for acquisition of an imported asset is adjusted to the cost of the asset at the time of payment as per section 43A of that. Means we have to account for the fixed asset only whatever actual payment has been made on that account. What is the treatment for these exchange differences relating to foreign exchange liability or borrowing for acquisition of asset within India as per ICDS 6 read with the presence of Income Tax Act and the rules made therein?
So, like Achalji mentioned in the previous question only, these questions, they have the answers embedded within themselves. So the answers are already there. So basically the 43A, it contains special provisions which are consequential to the changes in the rate of exchange of currency. So this provides that where an SSC or the company has acquired any asset or in the previous year from a country outside India for the purpose of the business or profession. I'm trying to capture all the conditions which are mentioned in 43A. And in consequence of a change in the rate of exchange during any previous year, after the acquisition of such asset, so there is an increase or reduction in the liability of the SSC, which is as expressed in the Indian currency at the time of making payment. Then it will be towards the whole or the part of the cost of the asset, or it can be towards repayment of the whole or the part of the money borrowed by him. Right. So the amount which the liability as I mentioned, so increased or reduced, whether the liability increased or reduced during such previous year, which is taken into account at the time of making the payment. And I'm saying irrespective of the accounting adopted by the SSC, it shall be added to or reduced or to be deducted from the actual cost of the asset as defined in clause 1 of 43. There are 4 more things. It can be the amount of expenditure of a capital nature. Then you have to add or reduce from the amount of expenditure of that capital nature as referred to in clause 4 of the subsection 1 of section 35, or the amount of expenditure of a capital nature which is referred to in section 35A, or the amount of expenditure of capital nature referred to in clause 9 of section 1 of section 36, or the cost of acquisition of capital assets. So when we read the, like Achal already mentioned, that when we read the act, we need to read all the sections, and the act and the rules will prevail. And these ICDS, the Income Computation and Disclosure Standards, they are a guidance which are there to help in computing the right kind of income and right kind of expenses. So basically the impact will be taken into account and will be adjusted accordingly.
Thank you, sir. Before now we'll be running out of time. There is one question in the chat box regarding consolidation. Praveen sir, please explain this one. Someone has asked that to even out inconsistencies at the time of consolidation due to difference in reporting period from year-end point of view, is it advisable that overseas subsidiary, associate, joint venture party financials are also aligned with the Indian parent company?
Yeah, this is something which I had mentioned when I was addressing the question, that generally, practically speaking, they generally align. because then it becomes easier. Otherwise, under IFRS environment or Ind AS environment, the date between the reporting period are permissible, but not more than 3 months. But generally, practically speaking, the management accounts are prepared on the date, on the same date, and then these are sent.
That might not be adopted for presentation to their authorities.
Yeah, that's fine. That's okay. That's okay.
That at least they are adopted by the board for that quarter, because
Absolutely.
in 3 months time there could be substantial transaction affecting the financials of the parent, Indian parent entity.
Absolutely, absolutely. And the auditors who are doing consolidation, they will need to consider the auditing standards, and they need to communicate with the component auditors, and also take into consideration the significant events which have happened between the audited financial and the date when these management accounts are being prepared.
Thank you, sir. Pramodji, would you like to
Right,
add?
right. Yes, yeah, one or two. There are various questions still by various participants. There are more than 1,000 participants right now watching. One thing which I like to the panelists to discuss about is in case of a foreign currency loan, say it could be an ECB, wherein say the rate of interest of the ECB is 3% and the corresponding rate of interest in Indian market for that same loan is say 10%, and there is an exchange fluctuation. So how that exchange fluctuation is to be treated in the financial statements as per the accounting standards or Ind AS. Now, suppose simple examples of suppose there is a loan of say 10 lakh rupees or say 50 lakh rupees, and the rate of interest is 3% for the foreign currency loan, and the similar rate for the banking channels is 10%, and the exchange fluctuation is say 1 lakh rupees. So that whole exchange fluctuation, bringing it to market at the year end, will that go to statement of profit loss or what? So what is the treatment there in the books of accounts and income tax both?
So maybe I'll just try to dissect the issue instead of combining. So I'll put it in different areas, different buckets. So bucket one, the interest on foreign exchange, foreign loan. That is one part. So whatever interest liability is, that has to be recognized, exchange rate to be applied on the reporting date, and whatever on the exchange rate fluctuation has to be recorded according to that. That's one part. Second part is comparing the foreign rate of interest on foreign exchange versus Indian rates of interest. I think the liability of the company to pay the contractual liability comes according to the exchange, the rate of interest which are there in ECB loans. So from that perspective, it becomes slightly irrelevant whatever rates Indian banks are giving. But in case this ECB is from a related party, then you get into a issue of whether the transaction is at arm's length or not. Then you need to justify that you have taken the ECB at 3%, whereas the Indian banking rate is 10%. Then whether that 7% is an additional advantage, and why that advantage is there or not. And then you get into those reasoning and making adjustment that it should be this and that. So that exercise will be very relevant when you're making tax computations, that whether this transaction is a related party transaction, whether it falls under the purview of transfer pricing, and these transactions which are foreign transactions, whether they are at arm's length, and which method is being used to compute that whether that arm's length pricing is justified or not. And then tax officer may take their own view that your calculations are appropriate, or they need some more adjustments. So that's answer from my side. Maybe Achal can add to the whole thing.
So I would just add on this accounting aspect around it, because I think taxation aspect you have elaborated. So as around the accounting aspect, I would say, because the accounting standard provides specific guidance around it regarding some component of this forex part to be treated as interest, one aspect becomes important for us to understand is the intent of the company is to capitalize this interest portion, or are they planning to keep this entire component into the P&L? Because the way accounting standard will require this interest as well as forex will be that certain part of the forex loss, yeah, most importantly, it will be the forex loss, is allowed to be treated as interest as per the requirements of accounting standards. Now, that is going to help the company only if they are planning to capitalize it. So if the plan is not to capitalize it, both the components will go to P&L, only the nomenclature will change, or I would say the heads will change, or the classification will change. So that is one part that is to be required to be looked at. Secondly, if the intent is to capitalize, then yes, the accounting standard gives us an option wherein the part of the interest is something which is compensatory in nature through the forex loss which has arisen. And why this forex loss has arisen? Because instead of Indian market, we have gone to the international market and we have taken the loan at the lower rate. But even though the rate is lower, because of which interest cost is lower, we are getting some forex loss as an incurrence. Now, to the extent this forex loss will adjust the interest component, and I'm now comparing this interest component of international loan vis-a-vis Indian loan, if this loan was taken in India. Now, to the extent this loan interest difference will arise, that is the component which, as a part of forex, can be treated as interest component. Now, without the numbers, it's very difficult to explain, but I am just trying to cover it in a very conceptual manner. So now this component of forex, which is a kind of adjustment towards the interest cost, that is allowed to be treated as interest, and that is what accounting standard requires. Both under Indian GAAP and under Ind AS, the requirements are similar.
I think under borrowing cost, if it is relating to a qualified asset, then whatever be the forex losses, to the extent of interest saved, that has to be treated as borrowing cost and has to be capitalized if it is related to a qualifying asset.
Correct. That's correct.
That any loss over and above the difference between the exchange, difference between the interest to be borne in Indian currency and the interest to be borne in foreign currency, whatever be the difference, up to the extent we have paid lesser amount of interest, that is a borrowing cost. If it will be treated into profit and loss if it is not related to qualifying asset. If it is relating to qualifying asset, that will be treated as interest cost and has to be loaded to the capital asset.
That's correct.
So yes, so actually what happens that it would be a borrowing cost, and of course if it is a qualifying asset, then you have to capitalize. So what happens that in the computation of income, you will show that as an so in the financial statement, you will show that as a finance cost to that extent, and not foreign exchange fluctuation. But as per income tax ICDS, you will show that as a foreign exchange fluctuation. So allowability, if it is not a qualifying asset, everything would be in the profit.
Yes, definitely, sir. But if it is,
And yes,
sir, it is if you capitalize that amount,
then yeah, as per the AS we have to do, but as per income tax it is not required. So again, there would be certain qualifications.
Yeah.
The issue. There have been various questions not able to take. Just one which Baldev Rajji, many of us know him very well out here. He has given his viewpoint that why SBI rates are being taken by the company. That is because of the rule 25, read with rule 115 of the income tax rules, where they say that you have to take the SBI TT buying rates. So that is why the companies are taking the SBI rates and not the RBI rates. Not the RBI rates. That's all. But yes, we have got several questions, and many of the participants have thanked a lot for such an interesting discussion. And some of them have asked about that where can we see this recording. I just stated earlier that it is available at the same link. Also, you can go to the ICAI TV, and there if you go to the ASB channel, Accounting Standard Channels, there you'll find this and all others which have been done earlier. So you can all avail of that. And at the end, because we are run over time, I thank each and everyone. First of all, both the distinguished panelists, I would say, and dear friends, Praveen Kumarji and Achal Jainji. Thoroughly, the way you have made this subject understandable to the participants. I'm very sure that participants in the coming days would be watching it again whenever they have an issue on this foreign exchange. So they would be referring this video. And of course, Rajesh Jainji, having the full technical knowledge on the subject, the way he put the questions and then he has explained, asked those questions to the panelists, giving his views time and again wherever required. Very well deliberated, Rajeshji. So my thanks to all the three, and also to the Secretariat, Shalini Jindalji, who has been taking pains of doing all this organization work to get this dissemination of the standards to members at large. So thanks each and everyone, and thanks to all the participants for joining. Our Vice Chairman could not join because he's still traveling. He was in Delhi today. We had an ASB meeting, so he was there, so he was traveling, so he could not. So on behalf of him also, I thank each and everyone out there. Thank you, each and everyone. Thank you very much.
Thank you so much.
Thank you, Chairman, sir.
Thank you so much. Thanks, everyone. Thank you.
Thank you.